The moment that I realized this one thing, my entire perspective about liquidity changed. And that was the fact that liquidity isn't just highs and lows. The most important liquidity is always placed above or below some sort of confluence. And that confluence is typically a fair value gap. For those people that know what a fair value gap is, if you mark out for a fair value gap and realize that the market has missed a certain fair value gap just barely before returning on higher, what you should look for in price is for price to now deliver to this fair value gap from wherever it's currently at. So what you do is you find another fair value gap that will deliver you to the one that it missed. And essentially, once I realized that whenever highs and lows were created next to a fair value gap and it barely missing that, that's when I began turning this into a system that I actually followed. This is what I call an A plus liquidity setup, where the liquidity misses a fair value gap just barely. And there are plenty of examples to go off of in recent times. One of those was this low right here inside of the daily time frame, and the thing that it missed was this daily IFEG. While it looks like it completely ran through it inside of this day, what I was looking for in this day was a setup from the IFEG after it swept the liquidity, and I ended up still capturing a setup from this daily range. So if we zoom in to the daily time frame and scale down, you can see that there was still a wick that actually tapped into it and pulled back. This wasn't just some little pullback, it was over 100 pips. And this setup alone would have been enough for you to walk away with some bread that day. So this is what I look for, where typically we miss a fair value gap or any inefficiency just barely by a few pips. I am almost always confident that we are going to run on it later in price. So what you do when you miss it is you wait for wherever price returns and you try to find a high probability area to actually look for sells from. So as soon as you would get any sort of confirmation and you see price start running in that direction, you would understand that it's likely at the least going to take out this low before returning higher. So one, you have two options here. You can sell to the liquidity and take it out, and you can also wait for it to sweep that liquidity before returning up. Even if the narrative, the overall narrative is bearish, you will likely always get a little bit of a pullback in price when you sweep into a inefficiency where liquidity is resting right above, where it barely missed this point last time and then it went and swept it later. And that's essentially what I look for in my day-to-day basis, where if we miss a fair value gap just by a little bit, or we fail to fill it completely and then begin returning, you typically expect price to then continue and fill that inefficiency completely. This is another example of a fair value gap that doesn't get filled completely, and market then comes to fill that and finish that little gap that it left unfilled. And essentially, this is called the liquid strategy, where price is like out of place. It doesn't complete the move. And if it wants to run, it's similar to the concept of immediate rebalance. Immediate rebalance is something like this. So if a fair value gap gets printed like this and there's enough of a gap between the candles where a new fair value gap is going to form if this candle closes below it, then what immediate rebalance does is that it comes up and makes sure that no new fair value gap forms, right? So it comes up, makes sure no new fair value gap forms, and then price continues back in the direction it was heading. So it would look like this. Oh no. Let's go back right here. Almost lost the place in the chart. So it would look like this. Once price begins to pull up, if it leaves the gap like this, then this is the new fair value gap. If it pulls up even higher, this is the new fair value gap. If it completely rebalances the area, there's no fair value gap there at all. So similar to this concept, whenever price barely misses to fill a fair value gap just like this, it typically comes back and grabs it. In this case, we did actually fill it completely. And so if the narrative is actually bullish, then price can run up on the highs or whatever else it was aiming for without worrying about having to come back. But typically when we miss it just barely, then before the real move happens, it will come back down, sweep it. So if you're looking for a buy and you realize that price barely missed a fair value gap, like filling a fair value gap completely, then it might not yet be time to take the trade because you might get swept out. So either enter with a lower risk, accepting that you might get swept out of the trade, just in case you don't want to miss the trade, or just wait it out because typically the second sweep is the real sweep that ends up causing the move. That's why you might have heard a lot of people teaching the same strategy, where before you go in for the move, you wait for another resweep. These are people that don't understand what fair value gaps are and how precise they make your entries. But when you understand fair value gaps, you don't need to wait for another sweep. You know whether it fills it at the first time. Like if it fills it the first time, there's no point in price to come back later. It already filled it. The job is done here and it could continue higher. So in this situation, you can just get in off of the first sweep. But in a situation where price did not fill it completely, then yes, you can expect a second sweep and you can get in knowing where the move is actually going to take place. So let's try to find some more examples. I didn't prepare any, but here's another one right here. This would be more of a lower time frame execution because it happened inside of the next candle. But you can see once again, this high failed to fill the fair value gap completely. So it ended up going back up right directly inside of the next candle, and then it continued lower. You can see that price doesn't like to continue lower unless the job is finished. And in this case, the job was yet to be finished. Here's another example. Price wanted to go lower, but once again, it didn't finish the job. You can see that it didn't finish the job. It left this little inefficiency and it ended up sweeping this, closing above it even before heading lower. And this happens over price over and over again. This wasn't the best example because this was a consolidation range, but most of these other ones are a valid example of what happens when price fails to sweep and fill a inefficiency completely. In order to understand this liquid strategy, you have to understand how fair value gaps work. The daily inefficiencies are one of the most important magnets that you can use, and you want to essentially understand how to read fair value gaps, how to know when it's filled completely, how to know when there's more room for it to be filled. Understanding IFEGs, that's important in also trading this strategy. But let me just break it down for you one more time. There's two different ways to trade it. So let's say there's a high, equal highs, equal lows. Above the highs are a fair value gap, and below the lows are another fair value gap. Price comes up here, fails to sweep into this fair value gap and fill it, and then runs down on the lows and begins to run up. From this point, you simply look for some entry model. For me, it's an IFEG. I like to use IFEGs to confirm that price is running in a specific direction. So now that we tap into the first fair value gap, we swept the high. There's two options, right? I was just going off the flow and I already told you guys this is the entry that I use, right? Because in this case, what I was doing is I was aiming for this level, right? So that's your first entry possibility. You aim for the fair value gap that was missed. You aim for the high and the fair value gap that was missed the first time. The second thing that you can do is you can sell from it. And if there's an example like this where price was previously consolidating and it swept one side first into a fair value gap and you see it start running down, you know that the other side that it's likely going to sweep is the one that it left a low right above a fair value gap right there. So you can aim for that as well. That's it for this strategy. I hope you guys understand how I began to change the way that I looked at liquidity. It's not just random highs and lows. There's typically always a inefficiency above those highs and lows that will make it even more precise for you guys. Hope you learned how to trade liquidity from this video, and I'll catch you guys in the next one. Peace out.